All right, this is Brad with Evergreen Capital, and today we are going to be talking about tax loss harvesting. We're going to talk about basic tax loss harvesting, and we're going to talk about super advanced tax loss harvesting, which is basically adding leverage and a lot of options to the basic version of tax loss. So, this is a little bit outside of what we normally talk about. We talk a lot about private markets and just overall investing. This is a very technical part of investing, but it is incredibly powerful from a tax standpoint if you're doing this at the advanced level. You can certainly save yourself a fair amount of taxes at the basic level. So it's going to be valuable for both our younger audience members and also our older, wealthier investors are both going to get something out of this. But I think just to back up, we need to start with just the basics first, and then we're going to build from that. So the framework here is threefold. It is first, tax loss harvesting, then tax loss harvesting with direct indexing. And then third is the leveraged version. It's just adding leverage long short, just like a hedge fund, to tax loss harvesting direct indexing. So stick with me. I know that's complicated, but there's three versions of this. And so we're going to stack the benefits. The benefits are going to get greater as we go along. Starting with number one, just the simple vanilla tax loss harvesting. So at the end of the year, when you're looking at your stock portfolio and you see, hey, NVIDIA is down. Of course, NVIDIA keeps ripping higher. So maybe that's not the perfect example, but maybe one of your other investments, a utility stock, is down for the year. And you see, hey, it's got a 30% decline this year. Well, I can go ahead and say December 1st, sell that stock and book the loss, book that 30% loss that I can use that loss to offset other capital gains that I have that year in my portfolio. And so this is pretty powerful if you want to change around your portfolio by selling some of your losers to offset some of the gains from your winners. And then you can actually even go back the next year, 30 days later, and repurchase that position if you'd like. Of course, you've got to do a little bit of trading to make that happen. But the government lets you, within 30 days, go ahead and repurchase it. What they don't want to see you do is sell the stock and then the next day rebuy it just for the tax benefits. That would be a version of cheating, of course. So they want to make sure that there's some period of time between the sale and the repurchase for that stock to be at risk. So you are taking a little bit of risk that the stock rebounds during that time, and you would have missed out on that rebound, on the appreciation over those 30 days. But for the most part, the research suggests that the tax benefits tend to outweigh the missed opportunity because of course, the stock can also do the other thing, which is declined even further over those 30 days. So this tends to be a pretty effective way for individuals. Most people like to do it year end. Of course, you could be watching your portfolio all year long for these types of spikes, like when COVID happened or when the 2022 happened and we had a ton of losses in the stock market. It was a good opportunity to take some losses, book those against your capital gains. And so you can do it all year long, or some people just like to wait till year end, right around the end of November or early December, to go ahead and say, okay, I want to look at all of my stock holdings and I would like to individually select some of these positions to take advantage of this opportunity to book the loss. But you can also do it in a much more systematic way. And that's what we're going to do here with step 2 of tax loss harvesting. This is tax loss harvesting with direct indexing. Now, what's direct indexing? So for those of you that don't know, direct indexing is a more automated version of tax loss harvesting where you're not having to do the trading yourself. So with direct indexing, instead of just owning an ETF like the S&P 500, where it's one position, you own an ETF that holds all of the underlying stocks. With direct indexing, you personally in your brokerage account own every single stock in that index. So if it's the S&P 500, you would own all 500 positions. And therefore, you could have a lot more opportunity for some stocks to be down in order to book those losses systematically. So obviously, 500 stocks, you're not going to be doing this yourself. It wouldn't be super efficient for you to be personally trading this. But thankfully, we have automated computers now. And the computer can do this for us. The computer all year long can go in and recognize, okay, this stock's up, this stock's down. We're going to sell the losers, and we can repurchase something very similar immediately in the same sector, because if you own the S&P 500 direct index, there's actually 4,000 stocks. in the overall market. So the software can replicate your position, book the loss, and then you really don't have any fluctuations in your returns. You're still matching the index pretty close. It's not going to be 1-to-1, but it's going to be very close to what you would have gotten performance wise from just owning the ETF. But then you get this added benefit of all these tax losses in an automated, efficient way. And so that is tax loss harvesting with direct indexing. Because if you just own 30 or 20 stocks in your own portfolio, you don't own every single stock in this overall market, you just have fewer opportunities to do this. You might be hesitant if you own, say, 30 positions or 20, and you're like, wow, I really love Google. I don't care that it's down this year. I don't want to sell any of it. I want to continue to hold Google. Whereas if you own 500 in a direct index that's just replicating the overall market, you don't really care as much about any individual position that's down. You just want to replicate the overall performance of the index. And therefore, direct indexing is a much more efficient way to generate regular, recurring losses year in and year out. Okay, now, before we get to version 3 of tax loss harvesting, the supercharged tax loss harvesting, let's talk about the problem with tax loss harvesting just overall over a long period of time. Now, the problem is that over a long period of time, the market continues to steadily increase over time. Any given year could be down 30, even 50% in huge market moves. Very rare, but most of the time the market's up, as you know. Really, 2/3 of the times the market tends to be up over periods of 3-5 years. Over time, the market's steadily marching higher. And so as you go, you lose out on opportunities to actually take losses. So even as you start booking some of these losses, over time, you have fewer and fewer opportunities to book new losses because your portfolio overall, the basis of it, the underlying tax position, keeps climbing. So this is getting kind of nerdy, but it just means that over the long term, you lose the power of tax loss harvesting. It's just the power is very strong in the early years. Like you can book anywhere from kind of 7 to 15% of your portfolio can often, you can get that in tax losses that first year. So in other words, if you invest $1 million, you might get up to $150,000 in tax losses in those early, maybe even the first year. But it declines, it degrades over time. So in other words, by year 4, by year 5, you might only be getting a few percentage points. So $20,000, $30,000 of losses. And then long-term, it's 1 to maybe 3. So the percentage points of your overall portfolio. So over 10 years, maybe you get to recoup 40% of your total portfolio in losses, which is still amazing. It's still great, but just it degrades over time. It just becomes less effective. Now, how can we fix that? We can add leverage. So that is the long short version of tax loss harvesting, where you're adding long leverage. So it's borrowing to get up to, say, 140%, and you're going short 40%. So in other words, long 40, short 40. So you're still net at 100%. So you can still roughly match the index performance, whether this is the S&P 500, the Russell 1000, the Russell 3000. These are just different indexes that replicate the underlying positions of the market. Russell 3000 is basically the entire market. There's about 4,000 stocks. So Russell 3000 is probably 98% of the market value of the overall stock market. So you can, with this leverage, long and short, you can actually each year book more losses than you can otherwise by not going long and short. Now, why is that? Well, if you just think about it intuitively, if you are shorting stocks, the market continues to climb higher and higher, right? So when the market's climbing higher and you still have short positions on, that means you're betting against the market. You're betting against those positions. So in essence, you're going to have a lot more losses on the short side of your portfolio over a long period of time. Because as the market trends higher, those shorts are going to lose money. They're going to generate these losses. Now, why would you want that? Well, you've offset those losses by going long on the upside by going 40% higher than you otherwise could without leverage. So you're going long 140%, and short 40% to get that net 100. And that the long 40 should do better over time than your short 40. Why is that? Because the managers that we like to use, they've been doing this a long time. They are selecting the shorts based on factors, based on how great are these companies? Well, the short side, you want to select horrible companies. You want to select companies that have bad business models. And on the long side, you want to select higher quality companies. The 40% that's going long, you want to select companies that generate high returns on invested capital, companies that have great business models, that generate a lot of cash, companies with better balance sheets that don't have a ton of debt. So you're tweaking the index a little bit with your viewpoint on what are the better companies. Now, this isn't like investing in a hedge fund that's super concentrated in 10 positions that has their individual viewpoint on the market, and you're taking a lot of risk that they're going to miss completely versus the S&P 500. This still, because you're going to own 1,000 plus stocks, right? You are still taking a pretty much a market bet. It's just you're tweaking it on the margins in terms of maybe a shift towards value, a shift towards growth, a shift towards quality. These are factors by looking at all 1,000 stocks and having the portfolio weigh towards the better, the higher quality positions. So therefore, you should generate a little bit of alpha just on the underlying long and shorts. And then you should also generate a lot of tax alpha through these tax loss harvesting benefits. So I know we are getting extremely technical, but in order to generate the kind of great tax benefits that we can through direct indexing, long, short strategies, we have to get technical to understand these benefits. And the benefits are huge. So instead of being able to book maybe 40% of your overall investment over 10 years, you can get multiples of that by doing this in a long short way. So there's varying degrees of how long and how short we can go, right? But a pretty standard entry point into the long short world would be 140, as we've talked about, long, and 40 short. The first year you can get up to 30% of your invested capital. You can get it in a loss. Then you look at that over 10 years. Oftentimes, you can get 140% of your overall investment, right? So if you invested $1 million, you can get $1.4 million of losses, right, you can use to offset other capital gains. That's a huge tax benefit versus what we said with direct indexing would be more like 40%. So that's a lot more. By adding this long short feature to direct indexing, you can just get a lot more losses because, of course, over time, those shorts continue to generate year in and year out new losses for you to book to offset your capital gains. All right. So that I know was a lot, but maybe let's pause right there and get some initial questions from Jesse. Let's bring Jesse in here. So what questions do you have initially?
Is tax loss harvesting something that's available to everyone?
Yes. The leverage version, so version 3 that we went over, is not available to everyone, unfortunately. There's a couple versions of it. There is really the supercharged version that we talked about. The ones that we work with are higher end clients. The problem is it takes a lot of money to get started in those. That's $1 million investment. You can use existing holdings. So it doesn't have to be brand new cash that you're using to make this investment. You can use your current stocks. So you can use a portfolio that you have at Charles Schwab or even Fidelity, and you can go ahead and designate that portfolio, $1 million minimum, to this strategy. And then we can put the wrapper around those positions. So you're not having to write new cash, right? And then we can implement this strategy with our sub-advisor who handles all of the trading. That is a big hurdle to get over. Now, the basic level of tax loss harvesting is just hey, anybody that has stock. So you have a Robinhood account, you have your own Charles Schwab account, right? You can go ahead every year and go in and look at, okay, Nvidia's way up. I don't want to sell that. Google's up. Amazon's kind of, flat for the year, but a bunch of these other stocks are down for the year. So I want to sell some of those to book those losses by year end. So anybody can do that as long as you have stocks, right? The middle version, the direct indexing, anybody who is a client of ours can do that. We have the ability, our software has the automation in order to do that direct indexing tax loss harvesting. Now we have minimum thresholds to be able to work with us, but that's more of just on a minimum yearly fee. You don't even have to transfer a lot of money with us to get started. So yes, just about anybody can get started with either tax loss harvesting or direct indexing. It's the supercharged long short version that is a little bit tougher to get started with. That tends to be for higher net worth investors.
So, for the more basic side of tax loss harvesting, is it safe for most individuals to implement this themselves, or what kind of learning curve could you
Yeah.
expect to experience?
Yeah, the two biggest mistakes that younger people who are new to this make with tax loss harvesting is the wash rule that we talked about, where you rebuy the stock before 30 days. Usually I just wait 31 days just in case. But if you rebuy it, the IRS views that as a wash sale. They won't give you the credit for the loss. So it completely eliminates that loss. You can't use that tax benefit. So that's a big mistake people make. Thankfully, that most of the brokerage accounts are getting better at helping you track that. Like, it'll actually tell you probably shouldn't make this trade yet. The second one would just be maybe just, something that they really like, a stock that they really like, that they plan on holding long term. They think, oh, I'll sell it on December 1st and then I'll rebuy on January 1st, right? If it's a high growth and there's some news event over that time period, they can miss out on a big move up. And if they're younger, maybe the tax benefit wasn't going to be that big of a deal to them anyways, versus the appreciation that they might have missed out on say something like the growthier, like a Tesla, or if they own some smaller cap stock, right? That's super volatile, but they have an underlying viewpoint on that stock, right? We tend not to get into those weeds. We like people focusing on methodical when they're younger, just adding more capital to an index over time and not dealing with kind of the casino mentality of buying individual positions. But if you have a viewpoint on Tesla and it's your fun part of your portfolio and you want to own that stock, by all means go for it. But those are kind of the two ways I would say younger people make mistakes is they forget about this wash sale rule, or they focus on trying to save a few $1,000s on a tax loss harvesting strategy when they end up forgetting to rebuy and they miss the larger picture or a move in that 1 month period.
Hey, I make $100,000 a year. What's this strategy going to look like when implemented for me over maybe a 5-year period?
I wish you could just take that 100,000 and put it all directly into the stock market each year. But of course, you're going to have your expenses. But whatever you can end up putting in the stock market, maybe you're saving away $10,000 and you're putting methodically $10,000 into the market. And so that $10,000 that first year might generate, especially if the stock market is down, could generate easily 10 to 15% in losses if you're doing direct loss harvesting. So you're owning the entire market. In the S&P 500, it would be like owning 500 stocks in your brokerage account, in your individual account. You own 500 positions. So in a down market, sometimes even in a flat market that's volatile, if the market's just up and down all year long, that generates a lot of opportunities for the software to book those losses. So you might generate $1,000 of losses, which obviously isn't moving the needle for anybody. But the point at that age is if you're saving $10,000 a year and then you get raises, right? You just want to put this in place and put it on auto savings, right? Where you don't have to think about putting this new money into the market every month. You want that. Because then your dollar cost averaging into the market, whether it's up or down, that's a great way when you're younger to start getting exposure methodically to the market. And the software takes care of that as well. And then in the background, every day you want the software looking for these opportunities to generate more and more tax losses for you. Then long term, you get to the point where you're putting away more like $50,000, $100,000 a year as you age, and then that's generating very substantial loss opportunities for you year in and year out. So once again, in the beginning, it's not going to move the needle meaningfully for you. We're talking about a few $1,000s, but over the long term, it's extremely powerful. And so it's just good to get it in place.
Okay. What was that number you just said that would be big enough to make it be meaningful every year?
Once you start putting away 20, 30, $50,000 a year, it starts getting pretty powerful. All right. So what are the best use cases for tax loss harvesting in a direct index? Whether that be just a straight direct index or the supercharged version, which is the long short, that the version 3 that we just went over. The use cases for this are ample. The first one's just obvious. If you just have a brokerage account that's taxable and you want to generate these losses to offset other capital gains that you have, that's a pretty clear use case. But what happens if you have one position, maybe you work for a technology company and you feel like you're trapped. You feel like this thing has ripped the last few years. It's up 10x and it's become a substantial part of my net worth. Perhaps it's even 90% of my net worth. And it is also my entire employment. So now if you think about it, you have just allocated a ton of your net worth to this one company. Your entire financial net worth is basically tied to this company, because if, God forbid, you get fired, God forbid it goes bankrupt, that would be catastrophic to your overall net worth at that given time. What can you do about that? You could just certainly sell a lot of the stock. You could sell, perhaps you have RSUs coming up, options coming up that are happening in the next couple of years. You could just go ahead and sell and pay the taxes, which are substantial, especially if you live in California and New York. You could pay the taxes and just deal with it. And that way you are diversifying away from that company over time. You could also start storing up these losses via direct index well before maybe you get those RSUs. Maybe you know you're scheduled to get a ton next year and even more the year after. And perhaps you think the company, if it's private, you might think the company is going to go IPO in a few years. Well, that gives you some runway to put this in place and start storing up these losses like a squirrel storing up nuts before winter. You just think about this way ahead of time. This is tax planning. So that's one way. That might be across your entire portfolio. Maybe it's not just one position. Maybe you don't work for a company like Palantir or NVIDIA or Broadcom, where the stock is just up a crazy amount the last 5-10 years. Maybe you just have been a great investor and methodical over time and not sold anything for a very long time. And so your entire portfolio has all gains. Nothing has any potential losses in your portfolio because maybe you just own a bunch of ETFs or stocks that you've held a long time. So you have a frozen portfolio if you want to reduce the risk without paying taxes. This would be another way to go ahead and methodically over time get rid of some of that appreciated stock in a tax efficient way. Because as you start accumulating these losses, you can start selling your portfolio that is highly appreciated down over time without realizing giant capital gains, which could be upwards of 35% plus if you live in a state like California. What happens if you own your own company and you realize that, hey, we might have a liquidity event maybe 3-5 years from now, or even 2 years, right? You have some time to go ahead, especially at the high leverage level, to start generating some losses to deal with the capital gains that you might have in a sale of your company. So those are some use cases for our clients and people out there that can utilize direct indexing, tax loss harvesting in a leveraged way to really book giant losses to get ahead of some capital events, whether it be selling just stock they own or selling a company, selling a business, to offset those giant bills that are pretty painful when they come. Of course, those are good problems to have. But nonetheless, if we can mitigate that a little bit, why not do that with a smart strategy like tax loss harvesting? All right. And then lastly, I want to talk about, besides all the benefits we talked about, like, why is this interesting? Is this just a trend? Is this something that's not proven out and it will go away in a couple of years, or what? And I think this is really the next evolution of passive investing, right? We talked about kind of the tilts on value or growth you can do, but really just at the basic level 2 of direct indexing, where you're not putting leverage on it, that is really just replicating the index. And this direct indexing, where you get to own every position with software working in the background, I think is the next generation improvement over ETFs, right? Before ETFs, we had mutual funds. Mutual funds were improvement over owning 20 stocks yourselves, and you were picking them, but you didn't really know which stocks were going to do that well because you were doing it part-time and people were doing it with their newspaper, right? So that was kind of the initial version 1.0, investing in the stock market. Then version 2.0 was mutual funds, which was an improvement, but mutual funds were super tax inefficient. So ETFs was version 3.0 of investing in the stock market, because you could do it in an extremely diversified and tax efficient manner, because if the underlying positions were traded you didn't have a tax hit because you owned the ETF and not the underlying positions. Now, direct indexing, I think, is investing 4.0, is stock market investing 4.0, where you can own everything in the stock market in an automated, super efficient way, and yet benefit from all of these tax loss harvesting, which generates tax alpha, which is incredibly powerful over time. Any percentage points that you can generate above just the market performance have an insane compounding effect over 20, 30, 50 years. We're talking millions of dollars extra in your portfolio by the time you retire if you're able to add small gains year in and year out. And so that's what I think is exciting about direct indexing. I think everybody should be using it in their portfolios long term. Once again, when you're starting out, it's not going to dramatically change your portfolio, but you're going to grow. You're going to get more and more income as you climb the ladder at your corporate job. Exciting exit capital events from your investments, from maybe side gigs or opportunities that you pursue. And so you want to put this in place early and just get used to adding to it over time and having the software generate these losses for you. So anyways, that's my soapbox speech on direct indexing. I'm extremely excited about it for our clients at Evergreen Capital because we like to focus on not only unique alternative investments, but we like to do unique tax strategy to help our clients compound their capital. If you're interested in learning more about this particular strategy, go ahead and reach out, info@evergreencap.com, and somebody on the team will get back to you. All right, with that, I am going to end it. Thanks for taking the time and have a great day.